C'est parti. All right. Good evening. So that's just you and me, Katie. That's going to be a one-to-one workshop tonight. Lucky you. Yeah, I do understand that this is the Mid-Autumn Festival and that some of those who have registered might not be available tonight. And I understand. However, I hope that for the upcoming weeks, I hope that more of you can join the live event. As I said in the WeChat group, it's just more enjoyable for me to be able to talk live to as many of you. So yeah, please, if you can, of course, I understand that you might not be available on Tuesday's evening, but if you can, I would very much appreciate if you could do your best to attend the workshops and use this live event as an opportunity to ask your questions and just talk to me. Okay, all right. So we have a pretty busy schedule tonight because we are going to talk about 4 different A2 topics. And the reason for which we are going to talk about so many different things is simply because these topics are relatively straightforward, so I don't think I need to spend too much time on most of the content that I'm going to go through tonight. These are usually not topics that students find very challenging. But however, these are topics that are very often tested, especially in the form of MCQs. So the 4 topics that we will discuss tonight are everything about revenue curves, total revenue, average revenue, marginal revenue, and the relationships between those curves. Once we are done with that, we need to talk about profit, especially the difference between accounting and economic profit. And we need to have a closer look at what we call normal profit, abnormal profit, and subnormal profit. I'll use an example for that. Of course, we'll talk about profit maximization. How do firms maximize profit? We'll have a look at the optimum output rule. Then we will consider the alternative objectives that firms may have, especially in large organizations where there is a divorce of ownership and control. We'll talk about profit satisficing, sales revenue maximization, sales maximization, volume of sales. And finally, we'll talk about how firms grow, so the difference between internal growth and external growth. What are the main advantages that encourage firms to grow, and what are the main limitations? And finally, we will have a quick look at why, even though they are very large organizations, very large companies in national and international economies, why is it the case that there are still so many small firms? How can they survive in a business environment where they might face very big competitors? So we'll look at all this tonight, step by step. Almost all the documents are available on the website. I just need a little bit more time to prepare a summary and the definitions of the last topic on the growth of firms and the survival of small firms. But you can already download all the other documents from the website, the summaries, the concept cards, the definitions, and the PPTs that have been updated. Because yes, they are similar to the PPTs that I already uploaded on the website 2 years ago, because I did not get a chance to update those PPTs last year. But those you can download from the website right now are updated versions. These are the latest version, and they are better. Hopefully. All right, so let's get started, and let's have a look at the first topic. Let's talk about the revenue curves. This should take us about 30 minutes top, I think. Okay. All right, so revenue curve. There are 3 revenue curves that students must know. There is total revenue, the average revenue, and the marginal revenue. And this should not be very hard, simply because just before we have studied production theory, and in production theory, we already talked about total cost, average cost, and marginal cost. And it just works the same way, but instead of talking about the cost, an outflow of money, we talk about the revenue and inflow of money, but that really works exactly the same. So you should start with the definitions, okay? Definition and formula. Total revenue is usually quite straightforward, price times quantity, no problem with this. Make sure you give an example, so your students, they can make the calculation just to double check that everything is fine, but there should not be any problem. And then you can define the average revenue, which is simply how much the business will receive per unit of output. And of course, in this chapter, in this topic, we focus on businesses that charge the same price for everyone. Okay, we have not yet talked about price discrimination. You know that when businesses implement price discrimination, the concept of average revenue doesn't really make sense. Okay, but here we consider businesses that implement what we call uniform pricing, which means one price for everyone, same price for everyone, which means that, well, the per unit revenue is simply equal to the price. Okay, but you can actually see that from the definition. The average revenue is just the total revenue divided by the quantity sold. Okay, how much we make in total revenue divided by how many units we sell. Okay, just like the average total cost, that's the same formula. And if we work out this this definition or this formula, we just end up finding that yes, the average revenue is simply the price at which the firm is going to sell its product. And remember, here we consider uniform pricing, the same price for everyone. There is no price discrimination here. Again, you can use an example just to double check that, just to reinforce the formula and just to show your students how they can apply the formula. And something that they should understand too, even though this is not as important as cost functions, is that there is a graphical relationship between the total revenue and the average revenue. And this is the same relationship as we discussed in the case of the average total cost and the total cost itself. Yeah. So it's just, if you take the total revenue curve, and if you take any point on that curve, and if you draw a line between this point and the origin, then the slope or the gradient of this line is equal to the average revenue. Okay, same as before, no problem. And something that is extremely important to understand is that the average revenue curve from the business perspective is simply the demand curve. Okay, that's something that is very important. They are the same. Why? Well, simply because if you look at the demand curve, it basically tells you, all right, if you you can actually look at a demand curve from both ways. You can ask something like, okay, if I take one price, let's say $10, how many units will be demanded at that price? Okay, so you start from the price and you look at the quantity demanded at that price. But you can also look at it the other way around. You can say, all right, if I want to sell this quantity of output, or you can look at it from the business perspective, if I want to sell 100 units, what price should I charge? Or basically, at what price will consumers, will buyers demand exactly 100 units? Okay, and this is given by the demand curve. Okay, so if I am a business and I intend to sell Q1 units, I can ask myself, all right, if I want to sell Q1 units, what price should I charge? What is the maximum price, if you want? What is the maximum price that I should charge, or that I can charge to sell Q1 units? Well, the answer is given by the demand curve, and we call that the demand price. Okay, the demand price is the price at which buyers will demand a certain quantity. Okay, so a business who wants to sell Q1 units will charge a price P1, and that's why P1 here is the average revenue. Okay, so it's very important to understand that the demand curve is simply the average revenue curve. Does demand is equal to AR hold true? with competitive markets only. It holds true with all types of markets. It's actually true in all market structures. There is no exception. This is not something that depends on the characteristics of the market. It's always true because the demand, the individual demand, it's important. This might be the difference between one market structure and another. So when we say that the demand is the average revenue, we don't mean that the market demand. Okay, we mean that the individual demand, which means the demand facing one individual business. So if you look at a monopoly, there is no difference, okay, because you have one single firm in the market. So the market demand is also the individual demand. But if you look at a perfectly competitive market, then the average revenue is equal to the demand curve, but not equal to the market demand. It is equal to the individual demand curve facing each perfectly competitive firm. And in that case, you know that it is perfectly price elastic at the equilibrium market price. Okay, so yes, the average revenue is always equal to the demand curve, but not equal to the market demand curve, but to the individual demand curve facing each firm in the market. That's always true. And again, let me just repeat why, because again, the average revenue is just the price at which you sell your output. Okay, I think that's clear now. And the price at which you can sell a given quantity of output is simply given by the demand curve. Okay, the demand curve tells you if you want to sell Q1 units, you have to charge a price P1. If you want to charge more than P1, you will not be able to sell as many units as you want. It's going to be less than Q1. And if you charge a price that is below P1, well, you will actually, the demand will be more than Q1, which means that if you really want to sell exactly Q1, a price below P1 is not optimal. Okay, so that's why. Very important to understand that. True in all market structures, the demand, however, yes, it's the individual demand. Okay, good, no problem. Then final revenue curve, the marginal revenue, which is simply the change in total revenue that is generated by the sale of the last unit of output. So two things that you should stress. Instead of, you should not say that the marginal revenue refers to the increase in total revenue, because we don't know if the total revenue will increase. You know that it may increase as well as decrease. So it's more general, more valid to say change rather than increase. And again, should you say the sale of the last unit of output or the sale of the additional unit of output? Again, in fact, it is equivalent when you look at very small changes in quantity. Okay, when the change in output tends towards zero, it doesn't matter if you look at the next or the last, because it's essentially the same if you look at one point. However, there are some MCQs or where you have some tables and you have to calculate the marginal revenue. And if you use a definition that according to which the marginal revenue is the change in total revenue generated by the sale of the one additional unit, you might get things wrong. Okay, so to make sure that you don't make mistakes when looking at tables and calculating the marginal revenue, it's better to define it as the last unit of output rather than the additional. And again, you have an example, the same example with a Maria that is selling flowers, just to make sure that, okay, they understand how to calculate that. And okay, just like the marginal cost was the slope of the total cost curve, the marginal revenue is the slope of the total revenue curve. Okay, exactly the same as before. So because it measures the slope, if you have your marginal revenue that is positive, which that means that your total revenue is increasing. But if your marginal revenue is negative, this means that your total revenue is actually decreasing. Okay. All right, so well, that's essentially the relationship. Okay, here I just represented the total revenue curve that is just increasing. We'll see that it's not usually the case. Usually it goes up and then it goes down if we have a demand curve that is a straight line, because there will be a point where demand will become inelastic. So if we keep producing more, we will eventually lie on the price inelastic section of the demand curve. So total revenue will eventually fall. But that's just to show the relationship, like the graphical relationships between the three revenue curves. Okay. So if I take the Q1, for example, so TRQ1 is the total revenue. If I draw the tangent at that point, and the slope or the gradient of the tangent is the marginal revenue. And if I draw a line between this point on the total revenue curve and the origin, then the angle, the gradient of this line is equal to the average revenue. Okay, but again, this is not as important as for cost functions. There are quite a few MCQs where students are expected to know these graphical relationships between cost curves, but not that many for revenue curves, but it works the same way. Okay, now that's the most important part. The relationship between average and marginal revenue, because they are not the same. And students are sometimes a bit confused about that, because when you give the definition, you basically tell them, okay, so the average revenue is just the price, and the marginal revenue is the change in total revenue if you sell one more unit or something like that. So then some of them intuitively, they will say, yeah, so then it must be the same, right? Because if the average revenue is the price, and well, if I sell one more unit, I receive the price, right? So which means that my total revenue will increase by an amount that is equal to the price. So the marginal revenue should be equal to the price, and the average revenue is equal to the price, as we said. So they should be the same. This is what some students, that's the intuition that they may have, but unfortunately it is wrong in most cases. Why? Simply because in most cases we look at demand curves which are downward sloping. What does it mean? It means that if you face a demand that is downward sloping, the only way you can sell more output is by decreasing the price. That's it. Okay, you have to decrease the price to increase the quantity demanded. It is as simple as that. But of course, you cannot just decrease the price to convince one additional buyer to purchase your product, and leaving the price and keeping the price high for all the other buyers. Remember that we assume that there is the same price for everyone. Okay, so if you want to attract one more buyer, it means that you have to decrease the price for everyone. Okay, so the price will be lower to attract this additional buyer. Okay, but it's going to be lower for everyone. By everyone else, I mean those who already purchased the product at a higher price. And that's why the marginal revenue is going to be less than the average revenue. Okay, let's try to be a bit more specific. All right, so of course there is like a good news and there is a bad news. If you decrease the price in order to attract one more buyer, okay, so the good news is that because you sell one more unit of output, your total revenue is going to increase essentially by the market price. Okay, this lower price. Your total revenue is going to increase by the lower price at which you now sell your output. So total revenue increases by the average revenue. Okay, so that's like the good news. But there is a bad news. The bad news is that all the units that you previously sold, okay, or that you already sold at a higher price, well, all those units, you now sell them at a lower price. Okay, so let's say that you initially sold your 10 units at $10, okay, and in order to sell one more unit of output, okay, so to increase from 10 to 11 units of output, you have to decrease the price from $10 to $9, okay. So of course your total revenue increases by $9 in the sense that, okay, now you have one more buyer that pays $9 for your product, okay. That's the increase in TR that is equal to the average revenue. But the problem, or the bad news if you want, is that now the 10 units that you initially sold at $10, now you only sell them at $9. So you lose $1 for each of those 10 units. So that's the bad news. Okay, so and eventually, what does it mean? It means that your total revenue increases by the average revenue, but at the same time, it decreases by a certain amount. And this amount, you can actually calculate it. And this is what I have there. It is the price decrease, so the change in price, the decrease in price, multiplied by the quantity initially sold. It's going to be easier to see that on diagrams. Okay, in the PPT, I use a lot of diagrams to show that. And that's why, because you have to cut the price on all previous units to sell more output, this is why the marginal revenue, the change in your total revenue, will be less than the average revenue. All right. Let's try to see that. Okay, so for example, here, I sell 2 units. And if I want to sell 2 units, the maximum price that I can charge is 6. Okay, that's given by my demand curve. So of course, the average revenue for 2 units is the price $6. Okay, so my total revenue is $12. Okay, so far so good. What if I want to decrease the price to sell 1 more unit? So I want to move from 2 to 3 units. Let's say that in that case, I have to reduce the price from $6 to $5. Okay. Course, because the demand is downward sloping, so that I have to cut the price to sell more output. So now my total revenue is $15. Okay, so initially 12, now 15. Okay, so my total revenue increases, but we will see that it doesn't increase by as much as the average revenue. What happens? First, there is the bad news. The bad news, the loss in total revenue, is simply that, hey, initially you sold 2 units at $6. Now you sell those 2 units as $5. So you lose $1 on each of those 2 units. So your total revenue decreases by $2. The good news is that, hey, there is a third buyer now. So we have more output sold, and this third buyer will pay $5 to purchase your product. Okay, so you increase your total revenue by $5, which is the average revenue. Okay, the new average revenue at the lower price. Okay, that's your new average revenue. Okay, $5, the new price. So at the end of the day, the marginal revenue, which is the change in total revenue. Okay, so that's the total revenue when you sell 3 units minus the total revenue when you sell 2 units. 15 minus 12, which is only $3. Okay, so the total revenue has only increased by $3, which is less than the average revenue when we sell 3 units, which is $5. Okay, so the marginal revenue generated by the third unit of output is less than the average revenue when we sell 3 units of output. Okay, easy. I can do it again. Okay, I'm not gonna spend too much time on this. I can just keep going down the demand curve, and in this case too, I decrease the price. I sell 1 more unit. There is a bad news. We sell our previous units at a lower price, and there is a good news. We sell more output. And again, I can conclude. I can see that, hey, look, this means that my marginal revenue is going to be less than the average revenue. I think there are 3 examples. Okay, so I was the second one. There is a third example. And I think what's interesting, okay, so here my margin revenue is still positive, $1. So in the second example, MR is still positive, so TR still increases. But in the third example, you see that what you lose is greater than what you gain. So your marginal revenue is actually negative, which means that your total revenue decreases if you sell a 5th unit. Okay, that's quite interesting, because yeah, the reason, we'll talk about that in a minute, but this relates to the PED. If you keep decreasing the price, selling more output, your demand will eventually become price inelastic, given that it is a straight line. So cutting the price will not attract many new consumers, at least as a percentage change, and therefore overall your total revenue will eventually decrease. This is if you take the data from my 3 previous examples, you can actually grab this type of diagram. Okay, so that's just the demand curve, same as before, and you can grab the marginal revenue. Okay, so this is the actual shape of average and marginal revenue using the data from my previous example. And I can also grab the total revenue So I only have 4 points. That's not much, but still, I can show this 4 points, 1, 2, 3, 4. And yeah, it looks like my total revenue looks like a parabola, okay, increasing, then decreasing. And this is going to be the typical shape of the total revenue curve whenever you have a demand curve that is a straight line. We'll see it's not always the case, but whenever the demand is downward sloping and as a straight line, is linear, then indeed you will have this type of concave parabola as the total revenue curve. Okay, so that's essentially quite important to understand this relationship between average revenue and marginal revenue. It's actually something that when students talk about, if they want to write an essay about market structures, especially about monopoly, they need to explain that. They need to explain briefly, of course, but they need to explain why on the monopoly diagram, why the marginal revenue is less than the average revenue. Okay. In A2, we almost always look at demand curves that are linear. Linear means they are represented by straight lines. The only exception is when we look at demand that is isoelastic, where the elasticity is constant and equal to 1 at all points along the demand curve. And in this case, the demand curve is actually decreasing and convex, okay, like 1 over x, something like that. But in all other cases, we usually look at demand curves that are straight line. And therefore, your students, they must be sure to graph the diagram right, okay? So assuming that you work with a demand curve that is a straight line, then both AR and MR, they have the same vertical intercept. I can show it to you in a minute. The marginal revenue is also linear, so it's also a straight line. And the marginal revenue curve is exactly twice steeper than the average revenue curve. Quite important. I can show it to you if you want very briefly. Why is this the case? Let me just share the whiteboard. Why is this the case? Let's say that I have a demand curve that is P is equal to A minus BQ, okay, because it's a straight line, assuming demand is a straight line. If I want to look at the total revenue, it's just P times Q, yeah, just something like that. Total revenue is P times Q. So it's essentially P, which is A minus BQ, times Q, which is AQ minus BQ square. Blah, 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 square. Okay, so this is actually the total revenue. Okay, you got it. That's the total revenue, AQ minus ABQ square. And well, something they don't have to know, but you know, because the marginal revenue is the slope of the total revenue, this basically means that the marginal revenue is the derivative of the total revenue curve, okay? And A2 students should be able to calculate derivatives, right? So it's just A minus 2BQ. I don't know if you remember how to calculate derivatives, but that's, yeah, I guess most of them will know. So that's your marginal revenue. And what do you see? We see that, okay, the vertical intercept is A, just like your demand curve, okay, which is also the average revenue, okay? And the slope is twice steeper, minus 2B. Whereas the average revenue, the demand curve, has a slope of minus B. That's why. And of course, it's a straight line. A minus 2BQ, that's also a straight line. So that's how you can explain it to those who are a bit into math. Why do they have the same vertical intercept? Why is this twice steeper? You can just do this very quick proof. Should not be too complicated. And then you can simply move on. So yes, that's why the marginal revenue has the same vertical intercept as the average revenue, and it's twice steeper. So that's how you can graph it. Okay, same vertical intercept, twice steeper. Here we have a slope of B, and here we have a slope of 2B in absolute value. Okay, quite simple. Quite simple. All right, in AS, this is actually not really part of the A2 syllabus, but in AS, students have studied the relationship between the price elasticity of demand and the total revenue of a business. So they should remember. But just in case, I have copied the PPTs that I use in AS about that, just to make sure that they remember. So the typical idea is that if you increase the price of a product, you don't know for sure whether this is going to increase or decrease your total revenue, because it depends on how price elastic the demand for that product is. If the demand is very elastic, if you increase the price, you will lose many customers, and therefore your total revenue will decrease at the end of the day. But if your demand is very inelastic, you raise the price, and even though the price is much higher, you don't lose that many customers, and overall your total revenue rises. And the opposite is true if we decrease the price. If you decrease the price and you face a demand that is very price elastic, this means that a small decrease in price will attract many new customers. So therefore your total revenue will increase. But if your demand is price inelastic, even if you decrease the price a lot, this is not going to attract many new customers. And therefore, at the end of the day, your total revenue will fall. Okay, so I don't want to spend too much time on this because that's AS, the part of the AS syllabus. I like to introduce this as like, hey, there is a good news, there is a bad news. Like the good news could be something like you sell more. The bad news would be, hey, but you sell at a lower price. So that would be if you decrease the price. If you increase the price, the good news is, hey, every time you sell one unit, you receive more money. But the bad news is, yeah, but you sell less. You sell fewer units. So I like to explain how the total revenue will be affected by a change in price using this good news, bad news argument. All right, essentially. And that's the way I do it, actually. I consider all possible cases. And I use this, so of course, I remind the formula of total revenue, price times quantity. And you see, I use arrows. So like a big arrow means like a big change. For example, here, a big increase. And a small arrow means a small decrease. So looking at all those cases, you see how you can remember very quickly what's going to be the consequence of a price change on the total revenue, depending on the direction of the price change, whether the price increases or decreases, and also depending on whether the demand you face is elastic or inelastic. All right, but I think this is just a reminder from AS, so that should be okay. All right, so I'm gonna skip this. And at the end of the day, you can finish with this very important diagram. Okay, so we know that the demand curve, again, that's something that they know from AS. If you have a demand curve that is a straight line, that it goes from being perfectly price elastic to perfectly price inelastic. Okay, the PED decreases as we go down along it. We just said that the marginal revenue curve is same vertical intercept, but twice steeper. Okay, so that's how it looks like. And we know that the marginal revenue measures the slope of the total revenue. So as long as the marginal revenue is positive to the left of that point, my total revenue will increase. But as soon as the marginal revenue becomes negative to the right of this point, the slope of TR is negative, and therefore my total revenue becomes decreasing. All right, so we have this beautiful parabola. Of course, it starts from 0 and ends at 0. It starts from 0 because if you sell a quantity of 0, of course, you don't get any total revenue. And it ends at 0 because here this would be if you charge a price equal to 0. Okay, so if you charge a price equal to 0, you will sell this quantity, but you will not receive any revenue. So that's why your total revenue has this parabolic shape. All right. Last case, and actually I like to do it here. It's what if demand is perfectly price elastic? And I like to do it here because of course this is something that is going to be useful when we study perfect competition, because when looking at perfect competition, the individual demand, and of course we don't look at the market demand, but the individual demand is horizontal, perfectly price elastic. And this has consequences for revenue curves. And this is simply because if you have a demand that is perfectly price elastic at some price, let's say P1, then that simply means that you don't really need to cut the price to sell more output. And that's the assumption that we make in perfect competition. Okay, let's say that the market price is $10. If I am one individual business in that perfectly competitive market, this means that I do not need to decrease the price to $9 in order to sell more output. I can sell as many units as I want at $10, the equilibrium market price. Okay, and this is quite important because remember we said that why is the marginal revenue less than the average revenue? Because we have to cut the price to sell more output. And this was assuming that the demand curve was downward sloping. And this is always true when the demand curve is downward sloping. But if it is horizontal, it's no longer the case. You don't need to cut the price to sell more output. And therefore, every time you sell one more unit, you just receive the market price. So you just receive the price at which your demand curve is perfectly price inelastic. And therefore, you do not lose anything. Okay, you do not have to sell all previous units at a lower price to convince one more buyer to purchase the product from you. And therefore, in that case, this means that the average revenue is equal to the marginal revenue. They are exactly the same. So that's careful. That's only true when you have a demand curve that is perfectly price elastic. Yeah, that's because the firm does not need to cut the price to sell more output. So by how much will my total revenue change, increase in that case, if I sell one more unit? Simply by the price at which I sell it, okay? The average revenue. So yes, MR is equal to AR in this case. So I think I like to do this before perfect competition. So then when we move into perfect competition, they already know that, okay? You can say, hey, remember, look at the individual demand is perfectly price elastic. What does it mean in terms of the relationship between MR and AR? And that's a good opportunity for you to, and them to review this concept. And okay, so basically MR is constant and equal to the price. So which means you have a constant slope for the total revenue. So your total revenue will just be a straight line that will always increase at a rate equal to the market price. That's it. Okay, something as simple as that. So yeah, if this is your demand curve that is perfectly elastic at $10, so of course it's always equal to your average revenue. Okay, you see, so if you sell 2 units, your total revenue is $20. If you sell 3 units, you don't have to cut the price. It can still be $10. You don't need to sell your output at a lower price. So now your total revenue is $30. So you see that it has increased from $20 to $30. So your marginal revenue is $10, which is exactly equal to your average revenue in this case. And you see that you still have this gain in total revenue that comes from the fact that, yes, now there is a third seller who's purchased your product, but you don't have to cut the price on all previous units, and therefore there is no loss in total revenue. So yes, your marginal revenue is equal to the average revenue in this particular case. Okay, so yes, the demand is the average revenue, but it is also the marginal revenue in that case. And the total revenue would have this shape. It would be just an increasing straight line with a slope equal to the marginal revenue, always. And the marginal revenue is just the market price in this case. Okay, so it's constant. So that's why your TR curve increases at a constant rate. And that's it. That's it for revenue curves. So let me just show you again what we have. So as always, there is, you can find the concept cards. All right, so these are the concept cards. So only 4 here. What we have for the drawing challenges, we have Spider-Man and Hulk. The definitions, there are only 3 definitions. Pretty easy, right? Total average and marginal revenue, nothing else. We have not talked about anything else. And finally, you have a summary in only 4 pages. So 4 pages, and you have everything with all the diagrams, all the explanations about yes, everything the students must know about revenue curves. Okay, and we are done with this first topic. Do you have any questions before we move on? I'll give you 1 minute to think about it, and so I can prepare the documents. Any questions about the revenue curves? No questions? Okay. It's not that hard, is it, right? What really matters is to explain this relationship between AR and MR. They should really understand that. They should know the diagram with the 3 revenue curves: total revenue, average revenue, marginal revenue, and clearly understand the relationships that they have. Okay, so definitions, concept cards, summary over here. I don't need this. Okay. So let's talk about profit, because now we've talked about costs, we've talked about the revenue curve. So let's try to bring this together so we can talk about profit and profit maximization, of course. So profit is something that is sometimes a bit tricky, but let's start with simple things. Profit is just the difference between total revenue and total cost. Okay, that always works, and it doesn't matter if you and yes, we usually use the letter capital pi, okay, the Greek letter capital pi to refer to profit. That's what I do, at least, and that's what we usually do in most textbooks. So yes, it's always true. It doesn't really matter if you are talking about economic profit or accounting profit. Total revenue is clear, no problem. Total revenue, there is only one way you can understand it: P times Q. Okay, price times quantity, no problem. The problem really is the total cost, simply because there are 2 possible ways you can define cost. You can have a narrow definition where you would only include what we call the explicit cost, or you could have a broader definition of costs, according to which you would, of course, include the explicit costs. And I'm going to define this in a minute, but we would also include the implicit costs. All right, so that's why there are 2 types of profits, one that we call accounting and one that we call economic, simply because we use different definitions or a different measure of production costs. Yes, that's because a cost can be either explicit or implicit. What do we call an explicit cost? Well, an explicit cost is basically a payment that you make, that a business, because yes, when we talk about profit, we talk about businesses. So in this topic, we take the perspective of businesses, okay? So for business, an explicit cost is essentially any time the business has to pay the owner of a resource. Okay, anytime a business wants to hire a resource, to purchase a resource, it needs to give a certain amount of money, usually, yes, to the owner of that resource. Could be rent, wage, interest, profit. And that's an explicit cost. What I usually tell my students is, okay, anytime the business or the business owner just takes out his or her wallet and just gives money to the owners of resources, could be the employees, could be the owner of the factory, or another business that sells raw materials, anything like that, that's an explicit cost, okay? An implicit cost, I'll talk about depreciation in a moment. An implicit cost is the opportunity cost that a business is going to face when using a resource that it owns. And the best example that I found to illustrate that is actually not with a business, but I usually ask my students, do your parents own the house you live in? Okay, do they own the house in which you live? In most cases, the answer is yes. And then you can tell them, okay, so which means that they don't have to pay you rent every month to a landlord. And say, yeah, we don't have to pay. So then you can ask them, okay, what does it mean that it's free for you to live in your own house? Is this free? Because you don't have to pay. You don't have to pay anyone, right? So it should be free. And some of them will just say, yeah, it's free. Well, thinking about the explicit cost, it's true that living in your own house does not have any explicit cost unless you have to pay taxes. In most cases you do, but let's not talk about taxes. Let's just talk about like a rent. But some students say, yeah, no, it's not completely free because, okay, there is an opportunity cost because, yes, if we choose to live in our own house, then we give up the possibility of either renting it or even selling the place. So there is an opportunity cost. There is an implicit cost, essentially something that we might not necessarily see. Okay, it's not explicit. You can call it an invisible cost if you want, because there is a potential benefit that we lose. If you choose to use something that you own, you don't directly pay for it because it's yours, but because you might have done something else with it, you might have used it or rented it or sold it, you lose a benefit if you use it for yourself. And that's essentially the idea of an implicit cost. The other example that I use is I tell them the story of a taxi driver that has a problem with his car. His car just broke down, so he has to take it to a garage to fix it. Okay, so he brings the car, or he calls someone, and the car is is moved to a place to fix it, and it takes it's a pretty serious issue, so it takes 5 days. It takes 5 days to fix the car. And at the end of the day, the garage just sends a bill to the taxi driver of let's say 2,000 RMB. Okay. Then I ask them, all right, can we say that overall this incident has cost the taxi driver $2,000, the price of fixing the car? And then they start to understand where I'm heading. So and most of them will just tell you, no, not only because, yes, the taxi driver had to pay $2,000 to fix the car, which is an explicit cost, but the taxi driver has also lost 2 days of work. Okay, or 4 days, sorry, 4 or 5 days of work, because the taxi driver did not have his car. So he was not able to work, okay, assuming he did not borrow the car from anyone else. Okay, that's the assumption that I make. So you essentially lose the amount of money that you could have received if you had worked for 5 days. So even though this is not an explicit cost, this is a loss. This is a clear loss. This is the loss of a benefit for the taxi driver. So we can really define this as an implicit cost. So with those examples, they should understand what we mean by implicit cost. You can use more examples if you want. Okay, if you work for yourself, if you start your own business, you might not pay yourself a wage. So in that case, there is no explicit cost, but of course, because your workforce could be used for something else, there is an opportunity cost. Actually, I don't really, so sometimes in books you will see that an implicit cost is just an opportunity cost, suggesting that an explicit cost is not. But of course, an explicit cost is also an opportunity cost, because even if we pay with money, of course, we could have done something else with the money. Okay, so if I give $2,000 to my workers, that's definitely an explicit cost. But this is an opportunity cost because I could have done something else with the money. Okay, and basically what you can keep in mind is that all costs, explicit or implicit, are opportunity costs, all of them. Okay. All right. Yes, something a bit tricky. I don't really like that in the Cambridge syllabus, but they should know, the students should know that depreciation. So first they should know what this is about, and they should remember that, yes, In economics, depreciation has two meanings. This could be the loss in value of an asset, yes, but this can also be a decrease in the exchange rate. So they have to be careful when they see this word. They have to think about, okay, in what context are we? Are we talking about currencies, or are we talking about something else? Are we talking about capital equipment? If we talk about currencies, then of course depreciation means a decrease in the exchange rate. If we talk about capital equipment, depreciation means the loss in value, simply because your capital equipment becomes old and you have to replace it. Yes, so essentially there is a loss in value of your capital equipment every year, and it is considered, this loss in value is considered an explicit cost. And it's important to mention it because sometimes there are MCQs with tables, and students are expected to calculate the total explicit cost, the total implicit cost. It's important to acknowledge that the value of depreciation is considered an explicit cost, perhaps because accountants, they do take this into account. Accountants do measure and do include the loss in value due to depreciation when they calculate balance sheets for businesses. Perhaps that's why. Okay, it is an explicit cost. All right. Yes, so what is the implicit cost for a business? It is the lost benefit of the next best use of a given resource, of course. Then yeah, I've given some examples because we have 4 factors of production. So I tried to give 4 examples of implicit cost for each factor of production. So you can have a look at that, and just to make sure that this makes sense to the students. Yeah, that should be pretty straightforward. And this you feel free to ask them to try to find more examples of implicit costs for businesses. All right, and now we are ready to understand the difference between accounting profit and economic profit. And it's quite simple. It's just the only difference is, do we include all costs or do we only include explicit costs? Accounting profit, we only include explicit costs. Economic profit, we include all costs, explicit and implicit. And that's all. That's all, which means that basically the relationship between economic profit and accounting profit is simply that your economic profit is your accounting profit minus the implicit cost. That's it. That's it. And if we want to make a smart decision, we should base our decision for business on the economic profit and not on the accounting profit. Why? Simply because the implicit costs, even if we do not necessarily see them, they are as important as the explicit costs, of course. So we might make a very bad decision if we only focus on explicit costs, okay? And basically an accountant and an economist might make different recommendations to businesses simply because they don't look at the same things. Accountants only look at the explicit costs and benefits, but an economist would look at both explicit and implicit costs and benefits. So yes, and from, as I said, from now on, because for everything else in the syllabus, when we talk about profit, we always talk about economic profit. Okay, we don't only look at the explicit cost, we also include all the implicit costs. So it's only in this particular module or in this particular topic that we look at the difference between the two. But then for the rest of the syllabus, we only look at economic profit. All right. Right. Now, this is the tricky part. So far, it's quite easy, right? Usually, it's not very complicated for students. What is quite important is this concept of normal profit, and to understand what it means for a business to make more than normal profit, to make less than normal profit, or to make exactly normal profit. And the first thing that you have to tell your students is that normal profit is a cost. And that is pretty counterintuitive, but you can start with this and just let's try, give them some time to try to understand. Normal profit is a cost, okay? It's not a reward as such. Why? and we can be more specific. That's the definition of normal profit. It is the implicit cost of entrepreneurship. Just like the other factors of production, the use by an entrepreneur of his or her skills has an opportunity cost. And the easiest way to see that is just to see, all right, if I want to start, if I am an entrepreneur, there are actually several businesses that I might run, right? Perhaps I have several ideas, several businesses that I could start, that I could run. And of course, if I choose to start or to run business A, then I will be unable to run business B. Okay, so yes, I might make some profit when running business A, but because I can no longer run business B, I cannot do both at the same time, then I lose the profit that I could have made if I had run business B instead. Okay, and this loss in profit, so of course it's an implicit cost, it's not an explicit cost, it's a lost benefit. Okay, I do one business rather than another, that's an implicit cost. And the lost profit is called normal profit. So from that perspective, it's a cost. It is the profit that I could have made if I had run my next best business instead. Okay, but because I do not run this business, it is a lost benefit, making it a cost. Okay, so yes, normal profit is a cost, the implicit cost of entrepreneurship. And when I looked at textbooks, I felt like if we really want to understand how this all works, there was something missing to truly understand. So I've decided to go with my own way to explain the relationship between okay, the normal profit, abnormal profit, and so on. And to make the explanation as clear as possible, I have invented this term. This is not something that you will find in textbooks, but I hope that this will make sense to you. I defined this concept that I call the gross economic profit, which is essentially what is left to the entrepreneur once we have subtracted all costs, explicit and implicit, apart from normal profit. Okay, so it's not exactly economic profit, because economic profit, you subtract all costs, explicit and implicit, and you also subtract a normal profit. But basically here I subtract everything, but I still I have not yet subtracted normal profit, which means that that's how you can see, this is what is left to the entrepreneur. This is what the entrepreneur makes. Okay, because when we mean make normal profit, what does it mean? Okay, so of course your economic profit is your gross economic profit minus normal profit. Okay, you just have to subtract normal profit, the last cost that you have to subtract, and you get your economic or final profit. Okay, so yes, anytime I will say that this is what the entrepreneur makes, if you hear the entrepreneur, the business makes blah 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 profit, this means that the gross economic profit is equal to blah blah blah. Okay. Right, so yeah, which means that when we look at the normal profit, which is what the entrepreneur could have made in the next best business, or the next best alternative business, this normal profit is equal to the gross economic profit of the next best alternative business. Okay, what the entrepreneur could have made running the next best alternative business. So then it's quite easy, and that's why I really wanted to define this new concept that is a bit tricky, but then you'll see that it really makes sense. If an entrepreneur makes normal profit, so here, and that makes normal profit means that the gross economic profit is equal to normal profit. Okay. Then the economic profit is 0. Because remember, if you want to move from gross economic profit to economic profit, you just have to subtract normal profit. So if you make normal profit, they are the same. So overall, your economic profit is 0. And that's why, because in books, it's really hard to understand, right? Sometimes they tell you, okay, the business makes normal profit, so the economic profit is 0. It took me some time to understand why. This is simply because when they mean make normal profit, they mean what is left to the entrepreneur before we subtract normal profit. That's what they actually meant. Okay. In that case, if what you make is the same as what you would have made in your next best alternative business, okay, this is what it means, then, well, you just make just enough to carry on with the business, okay? The business that you currently run does not generate more profit than the next best alternative business, but it does not generate less. So, okay, you cannot do better. You cannot do strictly better by stopping your current business and doing something else. Okay, yes. So if instead, if you own the business, if instead you chose to run your next best alternative business, then you would be neither better off nor worse off. This is what it means to make normal profit. It means what you make today is essentially the same as what you could have made if you had run your next best alternative business. So no incentive to change. We'll see that later. This essentially means that normal profit is the entrepreneurship's transfer earnings, but we'll see that later when we talk about the labor market. Okay, so it's not necessary. You can skip this. You can even delete it if you want, because we will talk about transfer earnings later when talking about the labor market. Okay, now abnormal profit. What if an entrepreneur makes more than normal profit? So the gross economic profit is larger than normal profit. The only thing that it means is that what I make today in my current business is more than what I could have made if I had run my next best alternative business. Okay, well, that's good. This means that I should not change. If I changed, if I run my next best alternative business, I would actually make less money, okay, or less profit, if you will. And what does that mean? It means that your economic profit is positive, okay, because just using the formula that we had before, if what you make today, your gross economic profit, is more than your normal profit, this means that your economic profit, which is just the difference between the two, is positive. So that's why we say that a company or a business that makes more than normal profit makes a positive economic profit. That's why. And of course, in this case, you currently make more than what is necessary to keep running your business. Okay, because the minimum amount of profit that you need to keep going with your current business is normal profit, and you make more than normal profit. Okay, so you make more than enough, essentially. And of course, if you decided for some reason to stop your current business and to run your next best alternative business, you would be worse off, okay, because you would make normal profit, which is less than your current gross economic profit. Which means that, yes, what you do with your skills as an entrepreneur is perfect. Yeah, you have chosen the best business, essentially. There were several businesses you could have run. You have picked the best business. This is what it means. And finally, so of course, we can call that abnormal profit. We can also call that supernormal profit. Same idea. The last case is subnormal profit. So it's the opposite. The firm is going to make subnormal profit if it makes less than normal profit, which essentially means that the gross economic profit, what the entrepreneur currently makes, is less than normal profit. So it's less than what the entrepreneur could make if he or she run the next best alternative business. Okay, that's what it means. And therefore, in that case, the economic profit is negative. Again, how do we move from a gross economic profit to economic profit? We just have to subtract normal profit, the implicit cost of entrepreneurship. And here, because the normal profit is larger than what I make today, then this means that my economic profit is negative. Okay, what does it mean to have a negative economic profit? It means that I essentially make less than enough to carry on with the business. So I should stop. I should stop and run my next best alternative business. I would make normal profit, which is more than what I make today. So what I currently do with my entrepreneurial skills is not optimal. Okay, I should not carry on with my current business. I should stop and I should run my next best alternative business. Right, so it might take some time for your students to wrap their heads around this. So what I did is that I created an example that I called Joe's Farm to illustrate how this works. So it's the story of a farmer, Joe. And all right, so he's a farmer and he has some capital equipment that he owns, a field and a tractor. So he doesn't have to hire, it doesn't have to purchase that. But of course, there will be an implicit cost when using that field and when using that tractor. And well, he can choose between two productions, wheat or corn. So it's one or the other, okay? It cannot be 50-50. It's we do one or we do the other. So you should really see that as two possible businesses. And I just give you some data for, okay, how much money does he make if he produces wheat? So you have the total revenue, you have the wages of agricultural workers, so that's an explicit cost. You have the purchase of intermediate goods from other businesses, that's another explicit cost. So this is if Joe chooses to produce wheat, and I give you again the same information. If he chooses to produce corn, same idea. So you see that for now I have only included the explicit cost. I'm also going to add the value of depreciation, but remember that this should be regarded as an explicit cost. So it doesn't matter if he grows a corn or a wheat. In both cases, the tractor will lose $1,000 per year. So that's the value of depreciation. And let's now have a look at the implicit cost, because remember, he owns the land and he owns the tractor, but so there is no explicit cost associated with the use of these resources, but there is an implicit cost because he could have done something else with it. Could have sold the tractor. He could have rented the field, something like that. So there is an implicit cost when he chooses to use the resources himself for the production of corn or wheat. So let's just say that the implicit cost is $4,000. Okay, it doesn't matter again if he uses these resources to produce corn or wheat. All right, so now what are we going to do? Let's focus first on the accounting profit. All right, the accounting profit. So remember, we only include explicit costs, and we should make sure that we also include the value of depreciation. So if you calculate it, you have everything. So $12,000 was the total revenue, $2,000 wages, $2,000 was intermediate consumption, $1,000 was the depreciation. All right, so this is the accounting profit when Joe chooses to produce wheat, W for wheat. And I can do exactly the same thing if he chooses to produce corn. So now the total revenue is much higher, but the costs are also higher. The $5,000 was the wages, $8,000 the intermediate consumption, and we still have the value of depreciation. Okay, so if you were, if Joe hires an accountant and the accountant, of course, calculates accounting profit, well, the accountant would just tell Joe, hey, both businesses are actually profitable. In both cases, you make a very positive profit, but still you would make more profit when producing wheat rather than corn. $7,000 is greater than $6,000. So the accountant should still encourage Joe to produce wheat rather than corn. But remember, the accountant would really regard both activities as profitable. All right, now let's calculate the gross economic profit. So remember, how do we calculate the gross economic profit? We subtract all costs apart from normal profit. Okay, so here, the only difference between the only implicit cost, if you look at the story, the only implicit cost that we have to subtract if we want to calculate that gross economic profit is the $4,000 that we have here. Okay, that's the implicit cost of using the tractor and of using the field that he owns. Okay, so I can simply do that. So I simply have to subtract. Okay, I start from the accounting profit when producing wheat. I subtract the implicit cost of using the land and the tractor, and I get what we call the gross economic profit of producing wheat, $3,000. And I can do exactly the same thing. If Joe chooses to produce corn, I start with the accounting profit and I subtract $4,000, the implicit cost of using the land and the tractor, and I get $2,000. Okay, so what does it mean? This means that if Joe chooses to produce wheat, he would make $3,000, and if Joe chooses to produce corn, he would make $2,000. Okay, so now once we have that, we can calculate what normal profit is. What is the value of normal profit if Joe chooses to produce wheat? And what is the value of normal profit if Joe chooses to produce corn? Because of course it's not going to be the same. And remember, normal profit is just the profit, the money that I would have made that I lose if I run one business rather than the other. So that's easy. Let's say that Joe chooses to produce wheat. Well, in that case, he can't produce corn. So what he loses is $2,000. Okay? He cannot make $2,000. If he had produced corn, he would have made $2,000. That's what we calculated here. But because he has chosen to produce wheat, he has lost this benefit. He has lost $2,000. This is the implicit cost of entrepreneurship. This is normal profit. So the normal profit if Joe produces wheat is $2,000. What if Joe chooses to produce corn? So same thing. If Joe chooses to produce corn, then he cannot produce wheat, and therefore he cannot make $3,000. So the normal profit if Joe chooses to produce corn is equal to $3,000. Okay, what he has lost because he can only run one business at a time. That's what I explained here. Okay, so the normal profit of associated with wheat production is $2,000. And the normal profit associated with corn production is $3,000. Okay, so now let's see. Let's go back a bit. So remember that if I produce wheat, normal profit is $2,000. Okay, and what I make if I produce wheat is $3,000. So essentially, when Joe chooses to produce wheat, he makes more than normal profit. He makes $3,000, which is more than $2,000 normal profit, the implicit cost of entrepreneurship. And therefore, his economic profit is going to be positive. In particular, in this case, his economic profit is going to be equal to $1,000. Sorry, where is it? Blah, blah, blah. Yes, you see, if he chooses to produce wheat, his economic profit would be equal to $1,000 positive economic profit, which means that producing wheat is actually the best option for Joe. What if Joe chooses to produce corn? So remember, if he produces corn, he makes $2,000. But if I produce corn, or if he produces corn, normal profit is $3,000. So he makes less than normal profit, and therefore his economic profit would actually be negative and equal to minus $1,000. Okay. So you see that unlike what we found for accounting profit, when we calculated accounting profit, we found that both were strictly positive. So the accountant would say, yeah, good news, you can either produce wheat or corn. It's all good. You will make a profit in both cases. But an economist would actually see that, no. Only wheat production is profitable. There is only wheat production that generates a strictly positive economic profit. If Joe decides to produce corn, he would actually make a negative economic profit, which means that he should actually do something else. He should actually produce wheat rather than corn. Okay, so therefore, an economist would still tell Joe, hey, you should produce wheat rather than corn, just like the accountant, but would not regard corn production as a profitable activity. And the difference is the introduction of the implicit cost, and especially the introduction of normal profit. Okay. So honestly, it's up to you. This whole explanation is very detailed. If you really want your students to truly understand how this works, like this relationship, normal profit, what does it mean to make more or less, blah, blah, blah. And I feel like this is a good example. And if your students are confident enough, yeah, have like a strong enough background or knowledge of economics, then I feel like you can go ahead with this example. However, for the examination, they do not need such a detailed knowledge of the relationship between normal, abnormal, and subnormal profit. So you can just tell them something as easy as, hey, if you make normal profit, your economic profit is 0. If you make more than normal profit, your economic profit is positive. If you make less than normal profit, your economic profit is negative. And that might actually be enough. But if they really want to understand why, then this example can prove useful. Okay, we have finished the tough part. The rest is actually very easy. We need to talk about how we actually maximize profit. And I like to start with the concept of a break-even point. A break-even point is just a level of output at which profit is 0, economic profit is 0, which means that total revenue is equal to total cost. You can also write it this way. If you divide everything by Q, this is the same as saying that the P is equal to AR is equal to ATC. That's exactly the same idea. So 0 economic profit. And the price at which we sell this output, we sometimes call it the break-even price. Okay, so the demand price of the break-even point is called the break-even price. Simple. Okay, so that's why we call that the break-even point, because the profit is equal to 0, and we say that the firm breaks even. Okay, doesn't make a profit, but doesn't make an economic loss. However, if the total revenue is greater than the total cost, if the firm produces a level of output at which it is the case, so again, you can either write it TR is greater than TC, or you can write it AR is greater than ATC. That's exactly the same thing, right? Because if you divide TR by Q, you get the average revenue, which is the price. And if you divide the total cost by the quantity, you get the ATC. So it's exactly the same thing. So if this is the case, if the difference is strictly positive, then in this case, the business is going to make abnormal profit. So the firm enjoys an economic profit, no problem. However, if the firm produces at a level of output where the total revenue is less than the total cost, so TR is less than TC, or equivalently, AR is less than ATC, that's the same thing, then the economic profit is negative, which means that the business is facing an economic loss. So the entrepreneur makes less than normal profit. The entrepreneur makes subnormal profit. Okay, well, should be quite easy. How do we maximize profits? Well, that's again rather straightforward. You know the rule. We call that the optimum output rule. If you want to maximize profit, you should produce where MC is equal to MR. Well, you could of course explain it with math and just saying that use derivatives to explain that, but there is you can just use the intuition to explain why this must be the case. And simply because as long as the marginal revenue is greater than the marginal cost, it means that each additional unit of output generates more or a larger inflow of money than the outflow of money. Or basically, it costs you less to produce one more unit than the amount you receive in exchange. Okay, so in this case, every additional unit increases your profit. However, if the marginal cost becomes greater than the marginal revenue, this means that every additional unit of output costs you more than what it benefits to you, to the benefit that it brings you. So in this case, of course, you should not increase output, you should decrease output, okay? And you should stop producing at the point at which the marginal cost is equal to the marginal revenue. And what does it mean? It means that the last unit that you have produced has cost you exactly the same amount as the what you have received from the sale of that last unit. Okay, so that's why the last unit has neither increased nor decreased your profit, and you should stop at this point. Otherwise, if you keep producing, the marginal cost will eventually become larger than the marginal revenue, and your profit would decrease. So you can simply use this explanation, but you can also use diagrams to justify why this rule is the one at which will allow the firm to maximize profit. Okay, yeah, we can skip this. This diagram is very simple. The red curve is the total cost, the blue curve is the total revenue. And of course, if we want to maximize total revenue, if we want to maximize profit, we need to make sure that the vertical distance between the two is as large as possible. Okay, this is profit, the difference between TR and TC. Okay, how about here? So of course we have a break-even point here, by the way. Yes, we have another one at 0, but it's not very interesting. Yeah, because of course, well, total revenue is equal to total cost is equal to 0. That's also a break-even point. But how about this point? If you look at this point, this is clearly, we can see that this is clearly not the point at which we maximize profit. This is not the level of output at which the vertical distance between the two curves is the largest. What do we see? Okay, so we can, this is the profit, okay, pi 1, the vertical distance between the two. And we see that the slope of TR, which is the marginal revenue, is actually greater than the slope of the TC, which is the marginal cost. So the marginal revenue is greater than the marginal cost. What does it mean? It means that if I produce one more unit, my total revenue will increase by more than by the amount by which my total cost will increase. Okay, this is what it means. So therefore, if I increase output, I increase my profit. So in this case, at Q1, I can do better by producing more. Yes. How about Q2? So Q2, same thing. I can identify the profit at Q2, the vertical distance between TR and TC at that level of output. That's pi 2, no problem. Do I maximize profit? Well, even graphically, it's obvious that we don't. This is not the level of output at which the vertical distance is the largest. Yeah. And same thing, I can look at the slope of both curves. So the slope of TR, the marginal revenue, the slope of TC, the marginal cost. And in this case, I see that the marginal cost is much bigger than the marginal revenue. This means that producing the last unit has cost me more than the increase in total revenue that it generated. Okay, MC is greater than MR. Therefore, producing the last unit has actually decreased my profit. So if I want to increase my profit, I should produce less. So I should move to the left. And finally, if I look at this level of output, Q star, so I can identify the profit at that level of output, same thing, the vertical distance. And what do I find here? I find that yes, at this level of output, MR is equal to MC. We see that the two curves have the same slope, which means that yes, this is the level of output at which I maximize my profit. If I go to the left, if I decrease my output, I see basically that the two curves, they become closer and closer. And same thing if I go to the right, you see that eventually the two curves, they become closer and closer. So it is the point at which they have the same slope that the distance, the vertical distance between the two is the largest. So I like this representation to maximize for profit maximization. I don't think you will find it in your textbooks, but I think it's easy to understand this optimum output rule, MC is equal to MR, simply using this diagram. Of course, you can simply use something like that, MC, MR. So here to simplify, I represented them as straight lines. But if you want to represent MC as a like U shape, it's fine, okay? But I just kept it simple by drawing straight lines. So same thing, Q1, is this optimal? No, because at Q1, MR is greater than MC. Producing one more unit would bring me more revenue than what it would cost me. It would only cost me MC, but it would bring me a benefit of MR. Okay, so I should produce more. Q2, is this the best output? No, because at Q2, MC is smaller than MR. Sorry, it's the opposite. It's a mistake. This should be MR and MC. Okay, MC is greater than MR, which means that producing the last unit has cost me more than the benefit I received from selling it. I only received MR from selling that last unit, but it cost me MC to produce. So it was a bad idea to produce this last unit. And if I want to increase my profit, I should produce less. And eventually, okay, that's the best level of output. This is at that point that I cannot increase or decrease my profit. If I produce less, my profit will decrease. If I produce more, my profit will decrease. Okay, so if I change just a little bit my level of output, this would have no impact on my level of profit. You can actually put the two diagrams on top of each other. Yeah, one on top and the other in the bottom, and you would have something like that. Okay, but that's exactly the same intuition. I actually like this representation where, so you can really see the two different ways you can approach profit maximization, either looking at the total cost and total revenue, or looking at the marginal cost and marginal revenue. I think it makes sense to use this type of representation. Okay. Yes, easy, 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 boom, boom, boom. All right, so if we look at, because we have studied revenue curves, if we assume that we have a demand curve that is downward sloping, so remember the demand curve is the average revenue, the marginal revenue curve has the same vertical intercept and is twice steeper. If I consider an ATC curve that is U-shaped and of course a marginal cost curve that has a swoosh shape and that cuts the ATC curve in its minimum, then I can find the level of output at which I maximize my profit by using this MC is equal to MR rule. Okay, it's there. So MC is equal to MR just gives you the quantity that you should produce to maximize profit, but it doesn't give you the price. And this is a very typical mistake that students make. They tend, some of them, to write that the price is here, the price is there. This is that quantity that we maximize profit. So we just have to look at the price over here, which is not the case, because of course, if you sell your output at that price, well, you see that the quantity demanded will be much, much, much larger. It would be over here. Yeah. So MC is equal to MR just gives you the quantity. All right. Now you know that you want to produce Q star, that you want to sell Q star. You can ask yourself, okay, what price should I charge in order for consumers to demand exactly this quantity? And this is given by the demand curve. So you simply have to look at the demand price at Q star. So you move up until you meet demand curve and say, okay, if I want to sell Q star units, the quantity that maximizes my profit, then I should charge a price equal to P star. Okay, I can actually identify the profit, but for that, I need to calculate or to identify the average total cost at this level of output, but it's easy. I start from Q star, okay, and I go up until I meet the ATC curve, okay, and this gives me the average total cost at that level of output, right? Now I have everything I need to calculate profit. I can first identify the total revenue, price times quantity, the big rectangle. I can identify the total cost, ATC times quantity, and the difference is the profit. Ta-da! Easy, right? Yes, the cost, absolutely, it's a very good question. The cost curves, they include explicit costs, but they also include implicit costs. In particular, they include normal profit. Because remember, normal profit is a cost. It includes all costs. Because now, as I said, from now on, we only look at economic profit. So all the cost curves that we will look at for the rest of the A2 syllabus, they include all costs, both implicit and explicit. By the way, does anybody know the difference between profit and producer surplus? The difference between profit and producer surplus. Is it the same? No? No, do you mean you don't know, or do you mean they are not the same? Profit and producer surplus, are they the same or are they different? They are different, yeah. So what's the difference? What's the formula if you want to move from, say, a producer surplus to profit? You actually have to subtract something to move from producer surplus to profit. Any idea? What do we have to subtract to move from producer surplus to profit? Profit is equal to producer surplus minus something. No idea? Minus the fixed cost. Yes, you have to, because producer surplus only looks at variable cost because it depends on essentially the supply curve. You know, it's the area below the price and above the supply curve. And the supply curve is the marginal cost curve. And the marginal cost curve only depends on variable cost, of course. So producer surplus does not include, fixed cost. So if you want to get the profit, you need to subtract fixed cost. So yeah, there is a difference. There is basically profit is less than producer surplus. All right. Okay. Then I think the rest is, you see the rest of the PPT has this one step further arrow. I tried to look at several tricky cases. For example, here you see, hey, there are actually 2 points where MC is equal to MR. Look, there are 2 candidates. There is Q1 and there is Q2. So which one? But it doesn't matter. The answer is Q2, but it doesn't really matter. You can skip this. If you are interested, have a look at it, but I usually don't talk about it to my students. Same thing here. What if there are like 2 possible candidates? Q1, same slope. Q2, same slope again. So how do we know which one maximizes? Actually, one maximizes profit and the other minimizes profit. All right. And this is how I like to conclude my PPT on profit, simply by having a table. I give them the total revenue and the total cost. They have to calculate MR and MC. So then they can calculate the difference between the two. Boom, boom, boom. And then you see, as long as it's positive, yeah, we should produce more. It's profitable. We can calculate the profit. But as soon as it becomes negative, then we should no longer produce, because this actually decreases profit. So profit is maximized when I produce 6 units. And in this case, my profit is equal to 16. So why not 0? Because, you know, we said that, yes, profit is maximized when MC is equal to MR. So it should be equal to 0. It's true when you look at continuous variables, when the quantity can take any value. Okay, oops. Yeah. When the quantity is a real number, so it could be 1.46 or 1. Or 2.756, blah blah. Basically, when it's a continuous variable, yeah. So in that case, yes, you will always have MC is equal to MR at the level of output that maximizes profit. However, if we only look at integers 1, 2, 3, 4, 5, 6, this might not necessarily be the case. Okay, that's why. And actually, I made this on purpose, because if I picked figures so that there is a certain level of output at which MC is equal to MR, then we would not really know whether we should produce 5 or 6, for example, because in both cases, the profit would be exactly the same. So that would just be confusing. So I did this on purpose. And we are done with profit. Yes. Any questions about this? Okay, I'll give you, let's just take if you have any questions, you can type them. I'm just gonna take 1 minute to get some water, and I'll be back in 2 minutes. Okay, and then I will read your questions and answer your questions in 2 minutes. Okay, so no questions. Perfect. Oh, perfect. So really, where is it? Yeah. So same thing. Definitions, a bit more than before. Let me share the screen. Yeah. These are the definitions that relate to profit. These are the concept cards. 2 drawing challenges, a sunflower and a ladybug. And this is the summary. Only 2 pages. 2 pages where there is everything. Students have everything they need to know about profit. Right. I really want, for me, what matters the most, we should really insist on this concept of normal profit. Tell them, okay, it's a cost, it's an implicit cost, it's the implicit cost of entrepreneurship. It is the minimum amount that an entrepreneur must make. Otherwise, he or she will do something else. Basically, the second best business. That really is the key idea that is perhaps the most tricky part of this topic. All right. Okay, so we can move on. We've done the two biggest topics now. It's going to be much, much quicker. Mostly because the rest is not really economics, right? The rest is mostly business. And I like to make fun on business syllabus, saying that there is basically not much to understand. I should not say that. That's just very descriptive to me. So that should be quicker, because I feel like this is very straightforward. All right. I don't know. I don't teach business. Perhaps you do. So let's talk about the objectives of firms. So we need to make assumptions. We need to make assumptions about how firms behave, because otherwise we can't do anything, right? Yeah. If we consider that each business can have a different objectives, there is no way we can predict what's going to be the outcome in the market. So, and therefore we would not be able to work. So we make assumptions, and we assume typically that consumers we make three assumptions. Consumers maximize total utility, businesses maximize total profit, and governments maximize total welfare. So that's, of course, it's not true in practice, but these are the working assumptions that we use so we can analyze markets and economies. But the first thing is that even if a business wants to maximize profit, this might be not possible because, again, what is the rule to maximize profit? MC is equal to MR. MC is something that is not so hard to compute. Like if a firm really wants to calculate it, why not? You could really make a list of the extra cost that would be generated by an increase in production. And I guess most businesses, especially large businesses that can have have a better access to information, I feel like they can have a pretty good idea of what their marginal cost is, even though it's never perfect. But the marginal revenue is actually quite hard, because if you want to know what your marginal revenue is, you must have a pretty good idea about what demand you face. And in particular, you need to know what is the value of the price elasticity of demand. And to be more precise, you need to know the value of the marginal price elasticity of demand, which means exactly where you are on the demand curve. So my point here is that, yeah, MC is equal to MR. It sounds very simple, but it's not, because businesses might have a very, very hard time to measure MC and measure MR, and therefore they might make mistakes. Just choose an output at which MC is not equal to MR, even if they wanted to. So in practice, firms don't really do that. They use easier pricing strategies like cost plus pricing. So those who teach business, they know what that is, where you just calculate your average cost, and you just say, all right, so my price is just going to be a 12% above my average cost. Boom. So this way, I don't really have to, I don't need so much information about my marginal cost, my marginal revenue. And it's much easier to calculate an average cost than the marginal cost. And I don't even need a marginal revenue. So that's just easier. So you see, so in that case, it's not really that firms don't want to maximize profit. It's just that it's too hard. It's too complicated. Too much information is required for them to be able to find the level of output at which they truly maximize their profit. All right. And then even if, and then they might actually have other objectives. And that's the purpose of this PPT. And that's mostly true in big businesses. Because in those big businesses, there is something that we call a divorce of ownership and control. And this is a keyword, divorce of ownership and control, which simply means that the business is owned by one group and run by another. And why is this a problem? Well, what is the problem that can result from this divorce of ownership and control? We call this problem a principal agent problem. So I realize that this is something that sometimes students they find very complicated. So this is the example that I give them. Everybody goes to the dentist, right? And when we go to the dentist, what do? We hire someone to look after our teeth. We pay someone, but basically it means we hire a dentist for 30 minutes or 1 hour to look after our teeth. Okay. But there is a big problem. The big problem is that when we do that, we hope that the dentist is going to make decisions that are in our best interest. But how do we know? We don't really, we are not experts we are not dentists ourselves, otherwise we would not need to go there. So we can only trust that the dentist is going to make decisions that are in our best interest, right? But basically in that situation, there is something that we call an asymmetry of information, which means that the dentist has more information than we do about the health of our teeth. So if we go to the dentist and the dentist tells you, well, this tooth really doesn't look very good. I think we should plan I think we should schedule a treatment. It's very expensive, but I really feel like it's necessary. Okay, how do you know? How do you know if this dentist is really making a decision that is in your best interest, that you really need the treatment even if it's expensive, or if, well, this was actually no big deal, you could have done nothing and your tooth would have been absolutely fine, but the dentist is taking advantage of the fact that he knows or she knows and you don't to make more money. Yeah. So this is, to me, an example of a principal agent problem that is easy to understand. In the case of the dentist, we are the principals and the dentists, they are the agents, and we pay the agents to do something for us. But we don't know at the end of the day if the dentist is going to really make the best decision for us or the best decision for himself or herself. And there is the same problem with businesses, large businesses. Okay, you have the owners, they pay managers, directors to run the company. The problem is that the owners, they don't really know what's best for the company. Okay, they own the company, they don't run it, so they don't know the market, they don't know how it is organized, or they are not really involved in the business. So they just trust that the managers will make the best decision from the perspective of the owners, which basically means maximize profit. But same thing, it's difficult for them to tell because they do not have as much information about the business as the managers. So to me, that's an easy way to explain this problem. Okay, so then you can give a proper definition. The principal agent problem is a situation in which people that we call the principals cannot be sure that those who act on their behalf, the agents, or those that that they hire essentially, will act in their best interests as a result. And why this is the case? Because, well, there is one group which has more information than the other. Usually the agents, they have more information than the principals. Okay. Easy, right? So yeah, that's because the owners, they have their own interests, and usually the owners, what do they want? They want as much profit as possible. They want the firm to be as profitable as possible, but the managers, they might have other their own objectives that might be in conflict with the objectives of the owners. Could be to have the highest possible salary, to have the best reputation, to them perhaps they want the biggest market share instead of the highest profit. Maybe they just want a large office and a beautiful company car, private jet, those type of perk benefits. Yeah. So that there is a conflict between the two, and therefore the managers, those who run the company, they might not aim at profit maximization. They might aim at something else, such as profit satisficing. We will look at three here: profit satisficing, revenue maximization, sales maximization. And of course, I think we should mention another one, even though we will not take a deep look at it. Altruistic goals like fair trade, CSR, and CER, like corporate social and responsibility, corporate environmental responsibility. Yes, but of course, it's always difficult to tell whether when you have a business that just engages in fair trade, or when you have a business that implements some policy to protect the environment or to be good to the employees. It's always hard to tell whether this is a genuine interest in society, or a genuine willingness to protect the environment, or whether this is just something that they want to use to increase product differentiation, to convince consumers to buy their products. So eventually, this might simply be one way to make your consumers more captive, to increase product differentiation, to decrease the price elasticity of demand, and at the end of the day, to make more profit. In the case of the environment, we call that greenwashing. Greenwashing is when a company pretends it's green, but it's not really green. This is just something they say to convince consumers to buy from them. Greenwashing. In a rude way, we would just call that bullshit, but I don't think you can say that to your students. So greenwashing is better. Okay, so we can, basically what we have to do left is just to look at the three objectives, and that's it. Okay, so profit satisficing, and in general, satisficing is a combination of two words, satisfying and sufficient. It's just a decision-making strategy where you do not aim at making the best possible decision. You are simply happy with the decision, even if it's not optimal. Okay, so you aim for a satisfactory rather than an optimal solution. Why? Because sometimes you do that because it allows you to save time. Because if you want to make the best possible decision, it might be very costly because you need to collect a lot of information. You need to analyze a lot of information. It might be very tedious. So making the best decision can actually have a very high opportunity cost. And therefore, satisfying decision-making can just be some kind of a shortcut that allows you to make a decision that is maybe not the best, but at least you have not spent 3 days making that decision to find the best possible option. So profit satisficing is a strategy or behavior in which you have the managers. They do not really want to maximize profit. Their objective is just to generate enough profit to not to keep their jobs, because of course if they do not generate enough profit, the owners will just say, okay, next. Of course the managers, they want to keep their jobs, so they will simply generate the minimum amount of profit that is going to keep the owners happy. Okay. The owners, they have no idea what is the maximum profit that the business can generate. So the managers will just say, all right, if I generate, let's say, if I have a 2% profit rate of return, or if I generate $2 million or $2 billion in profit this year, the owners will be happy. Okay. So my objective is just to achieve this minimum target. And then once I have achieved this target, then I can focus on maximizing my own welfare, to increase my wage, or to buy myself a private jet, or to like focus on increasing my reputation, my prestige, or things like that. Okay, so that's the idea. The managers, they do just enough so they keep their shareholders off their backs, okay, happy. So then the managers can pretty much do whatever they want. They can maximize their own welfare, not the welfare of the owners. That's what we call profit satisficing. Then the two other objectives, revenue and sales maximization. And by the way, you see that maximization, I don't write it with Z, but with an S, because I believe maximization, minimization with a Z is American English. And because this is the Cambridge curriculum, I feel like we should use British English as much as possible. So that's why I use an S. Same thing with organize, maximize, blah, blah, blah. All that, make sure that your students use British English. Why would business, or why would managers want to maximize total revenue or to maximize their market shares instead of profit? Well, this comes from the fact, and this is important to understand, that that sometimes the pay that managers receive, their conditions, their prestige, that doesn't really depend on profit, doesn't really depend on how much profit they make, but rather it depends on the size of the company. So basically, you might, as a manager, you would have a better situation if you manage a huge company that makes little profit, rather than a small company that makes a big profit. Okay, that's the idea. To put it simply, the size matters more than the profitability. You might get a higher salary, you might, more prestige and everything. So that's why managers, they might sometimes make decisions not necessarily to maximize the profit, but to maximize the size of the company. And maximizing the size of the company might mean that you want to maximize your sales, which means your market share, or you want to maximize the overall revenue that is generated by your company. That's why, okay, it's important that the students know how to explain why this might be an alternative objective. Okay, how about the rules? How do you maximize the value of sales? So the value of sales is just the total revenue. And the rule is quite simple. You will maximize the value of your sales, the total revenue, at the level of output that I call QTR, at which MR is equal to 0. That's it. No explanation needed. I think everyone understands that at that point. How about if we want to maximize the volume? So volume means quantity. Okay, the volume of sales means the quantity of sales. We maximize sales at the largest break-even point. So remember, a break-even point is a point at which we make 0 economic profit. Why largest? Because they might be several. Sometimes you have 2 break-even points. So that's why I wrote largest break-even point. And of course, if we make 0 economic profit, this means that my total revenue is equal to my total cost, or equivalently, that my average revenue is equal to my average total cost. And I call this point QS. Okay, so QS maximizes sales. Why not something more than the break-even point? Simply because any level of output that is above or larger than this break-even point would generate a negative economic profit. And when we talk about sales maximization, that simply means we sell as much as possible without making a loss. Okay, otherwise, why not producing 10 billion units, right? Because we would make a loss. So we produce as much as possible, given that we don't make a negative economic profit. Right, that's not very important. Yes, it's this matters. Sometimes it's quite important to understand if one business changes objectives, let's say moves from profit maximization to revenue or sales maximization, It's important to understand the consequences that this will have on the level of output and on the price. And a rule that your students should know, we can see that graphically very easily, is that a business that aims at maximizing sales or revenue rather than profit will sell a larger output at a lower price. What you can do is to challenge them and to say, okay, try to draw a diagram that would show the opposite. Try to draw a diagram in which the level of output that maximizes profit is more than the level of output at which you maximize, let's say, revenue. And this is not possible. So, yeah. However, the level of output that maximizes revenue can be more or less than the level of output that maximizes sales. It depends. We don't really know yet. It depends on the situation. So, and something that is quite interesting, and I think it's a great thing that students could write in an evaluation, is that, of course, if you maximize revenue or sales, you don't maximize profit. Okay, of course. But this is in the short run only. If you do that, if you, let's say, sacrifice profit in the short run by maximizing revenue or sales, this might actually maximize your profit in the long run over a longer time horizon. Why is this the case? There are two possible ways you can see that. Remember, if you maximize revenue or sales rather than profit, you charge a lower price. I'll show you that on the diagram. This lower price might actually reduce competition. Two ways. First, there is the limit pricing argument. If you have a very low price, this might discourage new firms from entering the market. So you will have lower future competition. And the lower price might also kill your current competitors. And that's what we call predatory pricing. And in that case, again, if you kill your competitors, that means that tomorrow you will have less competition. So the low price, the idea is that the low price that is associated with maximizing revenue or sales might be bad in the short run because we do not maximize profit, but it might be good in the long run because we reduce the intensity of competition. And also remember that because we sell at a lower price, this means that we sell a larger output. This means that sometimes this may allow some businesses to reach critical mass. So something like, I don't know, a dating website where there are positive network externalities. If you want your dating website or any social network to be profitable, you need to make sure that you have enough users at the beginning. Yeah. So that's why this type of businesses, they usually start with a very low price, or sometimes they actually sell it for free, just to gain enough users. And once they have enough users, once they have reached critical mass, then they can increase the price. Okay. So same thing in some industries in which it's important to have as many users as possible, like social networks, dating websites, things like that. Charging a low price can actually be good because it attracts more people and it can increase the value of your network. So it's a bit more advanced, but I think it's interesting to talk about those positive network externalities. Okay, so that's profit maximization. We've seen that before, no problem. That's the same diagram as before. This is revenue maximization. So you see that when MR is equal to 0, yes, this is the quantity that maximizes my total revenue. This is the price at which I should sell my output, PTR. And PTR times QTR, this is the maximum total revenue that I can generate. And if we compare, look, the price is lower and the quantity is higher. If we compare the two, yes, lower price, higher quantity, lower price, higher quantity. And for sales maximization, the largest break-even point, so in this diagram, there is one single break-even point, which is this one. Okay, all output below QS generates a positive economic profit. All output above QS generates a negative economic profit. So the largest output that does not generate a loss, an economic loss, is QS, the break-even point at which ATC is equal to AR, or equivalently, TR is equal to TC. So at that level of output, yes, the total revenue, the profit is equal to zero. The profit is equal to zero. Total revenue is equal to total cost. Yes. In this example, you see that the level of output that maximizes the revenue is less than the level of output that maximizes sales, but this might not always be the case. Okay, could be the opposite. But in what is always true is that the price when you maximize sales is less than the price when you maximize profit. This will always be true. Okay. All right, and there is one last slide, which basically tells, well, in practice, things are more complicated. Businesses, they don't have one single objective. And of course, they have like so many different objectives because there are so many different stakeholders within an organization and even outside of the organization. Of course, you have the workers, you have the owners, the managers, the trade unions, the consumers, the governments. So of course, you have to keep everyone as happy as possible. So instead of just pursuing one objective, which is usually the objective of only one group of stakeholders, businesses, they pursue a multitude of objectives, and they basically simply have to prioritize or say, okay, what do we have to do first? What is the key objective? But then, of course, we cannot simply maximize profit without looking after our employees. We cannot maximize profit without looking at the consequences on consumers in terms of the product quality, for example, product safety. We cannot ignore the consequences with the relationship with the government, like doing some illegal things to have the highest possible profit. So according to those organizational and behavioral theories, firms, they in fact pursue many objectives, and which objective is going to be the main one depends on who has the strongest bargaining power among those different groups of stakeholders. Some of them are rather weak, others are very strong, and the business is likely to pursue the objectives of the strong groups of stakeholders and to ignore or to give less importance to the pursuit of the objectives of groups of stakeholders that have a weaker bargaining power. Okay, of course. So I feel like this is also something that deserves to be mentioned in an essay about the objectives of firms. I'm just saying that, yes, of course, when we study economics, we have to make assumptions. We have to keep things simple. In practice, businesses, they pursue multiple objectives, but then if we, it's going to be very complicated to analyze that in an economic model. So we make a simplifying assumption that firms pursue one single objective. And in most models, this single objective is profit maximization. Okay. And then you can discuss, it might not be realistic, blah, blah, blah. Okay. And we are done with the objectives of firms. So I told you it was pretty quick. Of course, again, you have the documents. So let's have a quick look. So the concept cards. So how many concept cards? Not many. So here the drawing challenge is Mona Lisa. So just a quick drawing, of course. But I'm curious to see if my students will be able to get this right. The definitions, I don't think there are so many. Perhaps just yes, just a few definitions that relate to the objectives of businesses, and the summary that you can already download, no problem. In 3 pages, because you have like diagrams, yes. In 3 pages, there is everything your students must know about the objectives of firms. I didn't talk about that, but yes, you can also download all the essay questions that relate to these topics. Okay, so types of cost, revenue and profit, the growth and the survival of firms. That's the last thing we have to do. Differing objectives of firms. That's what we have just done. Okay, any questions about the objectives of firms before we can briefly have a look at the last topic, which is the growth and survival of firms. Some documents have not yet been uploaded. They will most likely be uploaded tomorrow. But again, there is not much to say about the growth and survival of small firms. Any questions about the objectives of firms? No questions. Okay, too easy. Okay, so let's do this. Right, so two types of growth, internal and external. Internal is the most common form of growth, and it's a bit weird because in this PPT or in this topic, we mostly focus on external growth, right? Even though, at least for the different types of growth, even though in practice, when firms grow, a very large majority of firms, they actually grow through internal growth rather than external growth. Yes. So internal growth, we just make some money, and instead of just giving this money away to shareholders or spending it, we just reinvest it in the business. Okay, to hire more people, to build a new factory, or to increase the size of an existing factory, to buy more machine. So basically, we use the profit that we have made to increase our productive potential by buying more machines, by hiring more people, by building more factories, blah, blah, blah. That's internal growth, simple. External growth, we buy another business that already exists, or we merge with another business, and we'll see the difference between the two. But yeah, essentially this involves two businesses that decides to come together, merger, or let's say a big one buys a small one. That's really the difference between a merger and a takeover. A merger usually have two businesses that really consider each other as equals, and they talk and say, hey, why do we fight? Perhaps we would do a better job together. So yeah, let's just join together under common ownership. So yeah, and we'll see that there are many advantages when doing so. But it's not like one big business that eats a smaller business. Yeah, so it's important to understand that. I remember there are some essay questions where students are expected to explain, or maybe a data response, I don't remember, data response or an essay. So what is the difference? A merger usually describes the amicable, so which means friendly. So it's a friendly coming together of equals, whereas a takeover implies that one company, usually a larger company, wishes to buy another one, usually a smaller one, and well, sometimes the small company is very happy to be purchased by the big company. Okay, especially in the IT industry, you have many like small businesses that have developed some kind of an innovation, or they have developed an app, and then you have those big firms, Google, Apple, Facebook, that will say, hey, this little business is doing pretty good, let's buy it. And in this case, usually the small company is pretty happy to be purchased by Facebook, Google, and Apple. The owners, they make millions, and then they can retire at 25 years old. So sometimes a takeover can be friendly, yes. But sometimes the smaller firm might be reluctant to be purchased by the bigger company. And in this case, this leads to what we call a takeover, a battle, where the small firm is going to try to resist and to convince their shareholders not to sell their shares to the larger company. That's usually how it works. That's the difference. So remember, merger, two groups or more, could be more, but usually it's just two companies that just discuss and agree that together they will be stronger. Takeover, a big firm buys a small firm, usually, and can be friendly, could be hostile. Hostile is not friendly. All right. Now, there are different types of, actually, it's, see, there is a, will it be a new firm if merger happens? Usually, it usually is a new entity. But again, it really depends. They often keep the two names. They can actually rename the company, but usually they just keep the two names, one behind the other. That's what happens most of the time. Then in terms of the ownership, is this a new entity or is this an, do they, how can I put this? Or do they like include one company into the other? Honestly, I don't know. I guess it depends on countries, depends on where the company is registered, what makes most sense. I would assume that in most cases, they create a new entity, because otherwise, if you have just one company that now is like merged into another one, this would sound like a takeover more than a merger. Honestly, I'm not an expert at the legal aspects of mergers. I assume that in most cases, a merger gives birth to a new entity, a new legal entity. But who knows, perhaps sometimes for one firm agrees to be merged into the other one. I'm sorry, I don't really have an answer to that. I guess in most cases it's a new entity. So there is actually something that is a bit weird with Cambridge, is that if you look at most textbooks, or even not only textbooks, but websites, usually they will identify three types of external growth, not four. Cambridge, and I don't think I have seen that anywhere else. Cambridge talks or identifies four types of external growth. Okay. It doesn't make much sense to me, honestly. And you know which one is a bit weird? The one that does not really make sense to me is the lateral integration. Because in most books, in most sources, lateral integration is just the same as horizontal integration. Because if you move laterally, just like if you move horizontally. So in most sources that I have found, lateral integration is just exactly the same as horizontal. But for Cambridge, apparently there is a difference. So, well, of course, let's stick to the way Cambridge sees those different types of external growth. Okay, so we need to have a look at these four. It's very straightforward. If your students study business, A-level business, they already know that. Horizontal could be, okay, so it's a merger or takeover between firms in the same industry at the same stage of the production process. Okay, so two things, same industry plus same stage in the supply chain, basically. They do the same thing. Give examples. And usually what I do, it's not in the PPT, but I try to give examples of recent mergers or takeovers that illustrate a horizontal integration. So of course I change that every year, so that's why I have not included it in the PPT. But well, you know examples. I'm sure you have plenty of examples of mergers or takeovers that qualify for horizontal integration, or that can be considered horizontal integrations, and that happened this year or last year, perhaps. Yes, so you can give generic examples, just like I did, like between chain brands, hotels, food distributors, postal services. But it's better if you can give like real examples of takeovers or mergers that took place in the last couple of years, of course. Vertical, so same thing, same industry, but different stages of the production process, okay, different stages in the supply chain. Yeah, so they essentially contribute to produce the same product, but they do not operate at the same stage of the production process. That's the idea. So in the example I give, you can have like the production of oil. So of course, first you have to explore, then to extract, then to refine, then to transport. There is this well, production process, and you have multiple businesses that operate or intervene in this production process. So they are in the same industry, but each business does something different. So if you have like a merger or takeover between two firms in the same industry, but they do something different, it's a vertical integration. Then you have same thing with coffee. So it could be could be the coffee beans, the cocoa, the milk. You know, same industry, but different stages in the production process. If you want to produce I don't know, tiramisu, for example, you need all this. But something that is quite important about vertical integration is that it can go two ways. It can go two different ways. It can go upstream when you have, and this is only true for takeover. So careful, whenever you talk about a backward or forward vertical integration, we are no longer talking about mergers. We are only talking about takeovers, because if you want to know if the integration is backward or forward, you need to know who buys who, right? If it's a merger, you don't know that. So vertical integration in general, it could be a merger or takeover, but if you want to refine it and determine whether it's backward or forward, it only applies to takeovers. So it can be upstream, when one business will just buy someone that goes before in the supply chain, or it can go downstream if a business buys another business in the same industry, but that comes after in the supply chain. Okay, so downstream we call that forward integration, and upstream we call that backward integration. All right, so backward integration, one business takes over one of its suppliers, so someone before in the supply chain, and forward integration, a firm takes over one of its customers, okay, one of the other business to which it sells its output. So someone that comes after in the supply chain. So same thing, give generic examples. I gave a few generic examples, but for all these different types of mergers and takeovers, it's important that you use current, real and current examples. If you don't want to do it yourself, you can just assign this as homework. You can just say, all right, for next week, please give me one example of each type of integration. And of course, tell me what business and what do they do? Because sometimes the students, they just give you the name of the companies, but you might not know what they do. So what do they produce? Just to double check, just to check whether this is indeed an example of a vertical, horizontal, conglomerate integration, and so on. Right, okay, so let's talk about this weird one. I don't know, honestly, I really don't understand why we I really think it's the same as horizontal. I just think it's like probably a misunderstanding in the syllabus. But okay, for the exam, lateral integration is when you have two businesses who sell related goods, same type of goods or services, but these products, they do not directly compete. And actually, this could be complements, for example. This could be like two companies that produce complements that merge together, one that takes over the other. So examples, banks and insurance companies. So that's the favorite example of Cambridge in the MCQs. So of course, banks and insurance, they both sell financial services, okay? So it's related, but of course, a bank is more interested in deposits and credits, loans and deposits, whereas an insurance is more interested in just selling some policies to protect you against a risk. Could be any type of risk, but that's what insurance are about. So the two do financial services, but they still sell different products, and they are not directly competing. And sometimes banks, banks, they also sell insurances. My bank in France also sells insurance for cars, for housing, and for other possible risk, life insurance, things like that. Okay, mergers or takeovers between hotel chains and a restaurant chain. So this could actually be a complement in this case. So in both cases, they sell a service that could be an accommodation service for hotels, or could be just food service. I don't know how to say that for restaurants. So you see, they don't directly compete, but they are related somehow. Some hotels they have their own chain of restaurants. They work with the same chain of restaurants. And the last example could be e-commerce websites like Taobao and Amazon that can merge with online payment service providers like PayPal, WeChat Pay, Alipay. But you see that they are not directly competing, but they usually go together. If you want to buy something online, you also need to go through an online payment service provider. So these are the examples that I could find, but honestly, I don't feel very comfortable with this because I really tried to find other sources that could explain this better outside of the Cambridge curriculum, but I could only find textbooks or documents that mention this concept of lateral integration and that makes it something different from horizontal integration within the Cambridge curriculum. So that's a bit weird to me. Okay. And finally, the conglomerate integration, that's quite easy, is when two businesses merge or one takes over the other, and when there is no relationship between the products. You will see that's mostly to achieve diversification. What examples did I give? A tobacco company and an insurance company, a food company and a clothing chain. All right, so nothing that relates, no relationship between the products. That's a conglomerate integration. Then there is an exercise. Like this exercise, it's just to make sure that your students have understood how this works properly. So I have 8 examples. Yes. Let's do it together because the PPT does not include the key. So the first one, a firm operating an instant coffee factory takes over a coffee plantation. So of course it's the same industry. It's about coffee, so it's going to be vertical. And you have a company that purchases someone or business that comes earlier in the supply chain. Coffee plantation comes earlier than the instant coffee factory. So that would be an upstream vertical integration or backward vertical integration. 2 firms producing tires for cars merge to form one single company. This is, of course, a horizontal integration because they do the same thing. A tobacco company merges with a company that primarily sells dairy foods. That's a conglomerate integration. No clear relationship between the two. Unless you like to dip your cigarette in your ice cream, but I don't think that's something recommended. Conglomerate. An oil extraction company takes over one of its competitors. So if it's one of its competitors, it's another oil extraction company. So they do the same thing. So it's horizontal integration. A soft drink producer merges with a sugar producer. So in this case, same industry, because of course, if you want to produce soft drinks, sodas, you need sugar as one of your input. But in this case, you don't really know who buys who, right? It's a merger. So the only thing you can say is that it's a vertical integration, but you cannot tell whether it's a soft drink producer who buys the sugar producer or the sugar producer who buys the soft drink producer. So it's impossible to give additional information about that. You can't tell whether it's upstream or downstream. It's just a vertical integration. Can you say it's lateral for this one? Not really, because it's like sugar is clearly an input. Lateral integration should be something that do not really use the same inputs, okay? Because if it's the case, then that's clearly the two different steps of the same supply chain. So that's vertical and not lateral. If you remember the examples that I used for lateral integration, you see they don't use the same inputs. They don't use the same resources. You can't say that, hey, one is producing the resource for the other. So that's why that makes it lateral. Well, again, according to Cambridge. Soft drink producer merges with a sugar producer. Clearly, sugar is the input you need to produce soft drinks. So it's in the same supply chain. So that makes it vertical. Yep. Okay. What else? A retail coffee chain merges with a sports equipment manufacturer. So of course, here there is no clear relationship between the two. So that's a conglomerate integration. A pulp mill takes over a newspaper publisher. A pulp mill is a company that produces well, that basically produces paper, okay? That produces, the raw material, what you need to produce paper. So of course, if you publish a newspaper, paper is an input, okay? So it's gonna be a vertical integration. And who comes first and who comes last or next in the supply chain? Of course, the pulp mill comes first and the newspaper publisher comes later in the supply chain. Therefore, we can say that this is a forward vertical integration or downstream vertical integration. A company that comes before in the supply chain purchases a company that comes later in the supply chain. And a web search engine takes over a video sharing website. I was actually thinking of Google and YouTube. Yeah, so a web search engine like Google takes over a video sharing website like YouTube, but this could be Baidu and TikTok or or Bing and I don't know, Bilibili, something like that. Well, same thing. You see that it's clearly not vertical, because it's not the same final product. It's not horizontal because they do different things. It's not conglomerate because there is some relationship. Of course, if you want to find a video online, search engines can be useful. So I feel like this is a good example of a lateral integration where they are not directly competing, but they are related. Yeah, what do you think? I came up with that example. I feel like this is what Cambridge means when talking about lateral integrations. I did ask the question on the discussion. There is a Cambridge discussion board, and I tried to ask the chief examiner and say, okay, that's a bit weird, and I really didn't receive any satisfactory response, unfortunately. All right. Quickly, let's try to finish because I see it's already 9:30. Everyone must be, including myself, a bit tired now. So we have two things to do: pros of growth, cons of growth, survival of small firms. There are only 2 slides for the survival of small firms, so I'll try to finish this in 15 minutes. Okay. So what's good about growing? Well, if you are bigger, you have more market power. That's what we call the monopoly motive. Especially for the motives of growth, it's important to distinguish what type of growth we are talking about, okay? Because different types of growth, whether of different types of integration, have different limitations and different advantages. So for horizontal integration, if you merge with one of your competitor, you reduce competition, and therefore you increase your market power, so you can charge a higher price and eventually make more profit, make the demand less elastic because there are fewer substitutes. So that's one of the main benefits of growth. And of course, if you use vertical integration, so if you buy one of your supplier, then this might make it more difficult for your competitors to access a given technology or a given source of supply, okay? If I produce cars, so I need a lot of steel. And if I buy all companies who produce steel, then it's going to be complicated for my competitors to find steel, right? So that gives me some market power also. So diversification is only for conglomerate integration, right? So it's one way to spread the business risk. Of course, if you have, if your company produces many different products in many different industries, and if something goes very bad in one industry, then you still have your activities in other industries to keep your business afloat and make sure that you don't go bankrupt. Basically, the idea is that you should not put all your eggs in the same basket, right? So achieving diversification is something that can reduce the level of business risk you are exposed to, but only conglomerate integration. The comment of economies of scope, I'm going to skip that because I feel like the students are very confused about that. And this is a bit outside the scope of the syllabus. So I'm going to leave this aside, and I think you can delete it. It's a bit more complicated than economies of scale. So yeah, I'll just leave it aside, okay? If you are interested, you can keep it and explain it, but I don't want to spend too much time on this because I don't even talk to my students about that. Again, vertical integration might be good for you to secure your supplies. If you own your supplier, or if your supplier is actually the same company as you, it's easier to communicate, to make sure that you get your supplies delivered in time, you have better information. So it's especially useful for just-in-time processes where you just produce as soon as consumers have placed an order. So yeah, this might make you more responsive to consumers' purchases, decrease the cost of storage, because you have a better, you better control your sources of supply, essentially. Of course, horizontal integration can allow you to exploit internal economies of scale more fully, but this is only horizontal integration. Okay, vertical integration will not allow you to benefit from more economies of scale. Conglomerate integration will not allow you to benefit more fully from economies of scale. Why? Because economies of scale is your average cost decreases when you produce more of the same product. Okay, if you produce different products, you're not going to benefit from economies of scale. So that's mostly horizontal integration. Synergies. Synergies is essentially 1 + 1 is equal to 3. Okay, which means that when two firms come together, they are actually stronger than what they could, or they can produce more, or they can be more innovative, or they can be more productive, more efficient than what they could be individually. Okay, so 1 + 1 = 3. Together we are stronger than individually. That's it. Okay, sometimes a firm has to be large enough to overcome market saturation. If let's say a domestic market has become saturated, which means that there are basically too many firms in this market, so the profit margin has become very, very low. You may want to try to enter into another market. Could be the international market. You might want to start thinking internationally, but you need to be large enough, right, to do that. You need to be strong enough to be able to face the much tougher competition, the much tougher international competition. So sometimes firms, they merge together, one takes over the other, simply so they can be big enough to try to conquer other markets, and they will not be able to do this alone. Just like during wars, sometimes you have two countries or two regions that they choose to combine their forces to attack another region or another country, simply because they would not be strong enough to do it themselves. Okay. This, I think you can skip this one. Buying unique assets, I think we can leave this aside. I think I'm going to remove it. All right, so these are the main benefits of growth. the main reasons for which businesses might have an incentive to grow. But there are some problems, of course. The clear problem is these economies of scale. If we grow too much, we might start experiencing these economies of scale. There are negative consequences for consumers. So yes, of course, on the one hand, prices might be lower because the bigger firm benefits from economies of scale. So with a lower cost of production, there might be a lower price for consumers. But on the other hand, especially horizontal integration will increase concentration, which means that there are fewer businesses in the market. So each business has a stronger market power, and they can use this market power to charge higher prices. So this might be a bad news for customers. Yes. Okay, some limitations could also come from what we call the competition authorities, which are governmental agencies who will have to approve mergers or takeovers. Don't believe that businesses, they can do whatever they want. If you have two very large businesses that want to merge together, or if you have one business that wants to take over one other business, in most countries, those businesses, they need to have the approval of the government. So sometimes businesses they might be refused to grow, or to like mergers can be denied, takeovers can be denied, simply because the government is concerned that the bigger business is going to be detrimental for consumers. If the government is concerned that the bigger company will charge higher prices for consumers, will take advantage of its dominant position, then the competition authorities might actually prevent those firms from merging, or one firm from taking over the other. There's the problem of culture shock. You know that each company has its own culture, and when you have two businesses that come together, the two cultures might not go along very well. You might have some employees that might not feel confident working with the employees of the other business that have a very different culture. And why is this a problem? Because this might lead to what we call the skills drain, where some important workers might choose to leave simply because they do not really appreciate the working in this bigger organization. There might be some changes in the company culture, or they might feel like what they do is not valued enough. The bigger organization might take the division of labor one step further, which means that specialization is likely to increase in a bigger organization. And some workers might feel like, hey, it's not really interesting anymore. They might not really feel motivated working for a bigger organization with a different culture, with an increased division of labor, with an increased specialization. So they might simply leave. And if someone has been working for 10 years in a company and suddenly leaves with a very important experience, with the potential of training other workers, with very good leadership skills, this might eventually result in a decrease in the productivity of the business until they can replace those who have left. Okay, and of course, conglomerates, that's something that is specific to conglomerates. If you are, let's say, a company who produces, I don't know, beer, and if you buy a company who produces medication, you have expertise in the beer industry, but you don't really have expertise in the pharmaceutical industry. And therefore, because of that, you might make bad economic decisions simply because you are not knowledgeable enough, you are not experienced enough in that new unrelated industry. Okay, almost there. I want to thank you for joining me tonight because you are very, very brave. It's been a long workshop again. All right. So there are 2 slides left, and then we can relax. So yeah, let's start with an interesting statistics. In most countries, at least 90% of business units are small firms employing less than 10 people. It's important to remind your students this fact, because if you ask students, okay, give me the name of a business, they will always give names of big businesses, of course, because these are the ones they know with a brand image. But it's important to remember that, yes, every day we usually buy goods and services from very small businesses. Like the last thing I purchased was from the grocery store down my residence. It is definitely a small business. All right. So why do we have so many small businesses in the economy? It's important to understand that. Why not only big firms? Why not only large corporations? There must be a reason for which there are still so many small firms. There must be something good about being a small firm. So let's try to understand why are the main reasons for which there are so many small firms in an economy. Well, the first reason is that sometimes the market is just too small to sustain a big company. Okay, if let's say that if we are a small village with only 300 people, you're not going to have an IKEA, you're not going to have a Walmart, you're not going to have a Decathlon, you're not going to have like a super large stores, you're not going to have a huge mall, simply because there are not enough consumers. So yeah, sometimes they are what we call, could be a niche market, but places, areas where there are not enough buyers to sustain big corporations. Could be in the countryside, for example. In the countryside, you don't have huge businesses, huge stores, because there are not enough consumers. Okay. Sometimes they are only small businesses because competition authorities, they make it difficult for firms to grow. And this is the case in France, for example. We have a lot of very small companies, but we have very few medium and large companies. If you compare France and Germany, we have as a percentage of like per habitant or per capita, we have much more small businesses, but we have much fewer large businesses and medium businesses in France. And most people agree that the main reason is that the French competition authorities and the French regulations and the French business law just makes it so hard for businesses to grow. Could be actually, I wrote external growth, but this could even be internal growth. That businesses just find it too difficult to grow and they remain small, okay, because of the regulatory environment. So we have many small firms because even if they want to grow, they can't because of the government. Could be that the government is trying to encourage self-employment, like to be a micro entrepreneur or an auto entrepreneur. When you start just your own business and it's just you. So yes, on the one hand, the government can make it difficult for firms to grow, to become very big, but the government can also seek to encourage self-entrepreneurship when you start your own business. Could be with tax cuts, could be with some training, other monetary incentive just to encourage people to start their own business rather than remaining unemployed, for example. If you don't have a job, if you're unemployed, the government can try to help you start your own business. And sometimes you have small businesses that simply don't want to grow because, as we mentioned earlier, a problem that exists when one firm grows too much is that the owners, they lose control. If your business becomes too big, you don't really control everything that happens in your business. And there are some entrepreneurs who want to keep control of their organization. They don't want to be exposed to the principal agent problem. They don't want to have a situation in which there is a divorce of ownership and control. They want to keep control of their company. And they know that if they grow too much, they will lose that control. So there might be a reluctance from the entrepreneurs to grow too much. How about if we have an economy in which, in the same industry, you have very large firms, but at the same time, very small firms? How is it possible that the small firms survive when they face competition from very large, very powerful organizations? And there are plenty of examples of industries where, yes, you have like a few big firms, but you still have many smaller businesses that do very well. How can we explain it? Could be about the level of consumer service, consumer customer service. The idea is basically that small businesses, they tend to be more flexible. They can offer more personal services than bigger companies that tend to standardize their products. So, for example, you might have a better human connection with your hairdresser if he or she is the owner, and there is only one person working there. For example, when I was in France, when I was going to the hairdresser, I was going to a hair salon where there was only one guy. He was the owner. He had run his hairdressing salon for 30 years, and yeah, so I had a very good connection with him. If I had gone to a much bigger place with many different hairdressers, things might have been different. I might have to get my hair dressed by or cut by different people. So basically, the idea is small businesses, especially service providers, they can give more attention to customers. This is not always true, but this tends to be true. There is more human connection with small service providers than with bigger organizations, usually. So this is something that can convince customers to opt for smaller companies because they want to have this connection, this personalized service when they make business with them. Could be about the quality, that there are some industries in which small businesses are the only one who can actually provide very high quality products or customized products. So for example, if you look at the guitars, if you look at the big companies who produce guitars, they only produce standardized guitars. Okay, they have a catalog, and you just pick a guitar from the catalog. So it's not custom made. But there are so many small businesses that produce guitars, and they can customize it. So you just schedule an appointment with the guy who's gonna make your guitar, and you just discuss, okay, what do you want? Do you want the neck to be in this type of wood, this one? How long do you want the neck to be? What pickups do you want? Blah, 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 blah. So then you can really get a customized product. And usually large businesses, they don't really do that. Large businesses, they have a catalog, and you just pick from the catalog. So that might be something that consumers value when they have to decide whether to buy from a large company or from a small company. Could be that there are just very high barriers to entry. So you have small businesses within the market, large businesses who are interested in coming into the market, but they can't, simply because there are very high barriers to entry. Could be that a small business has a patent, okay, as an intellectual property title that prevents anyone else, even a large corporation, from using that innovation. So then even if I am a small company, large businesses, they can't compete with me, so I can survive. Could be that the cost structure in that industry is such that as soon as we produce too much, we suffer from very big diseconomies of scale. Okay, so let's say if let's say that essentially means that my minimum efficient scale is reached very quickly. So as I start producing, I can enjoy economies of scale, but then very quickly, even before I become a large business, I start to suffer from very severe diseconomies of scale, which means that in that case, it's actually not a good idea to become bigger. If I remain small, I will be more competitive than a larger company, because this larger company will have a much higher average cost of production. So in that case, smaller businesses are more competitive, more cost efficient than larger organizations, and they can survive. And in some countries, small businesses, they just receive more help than large businesses. So of course, if the government gives a lot of support to small companies and much less support to large companies, even if I am less cost efficient, even if I don't have as much money to advertise, to convince consumers to buy my product, if I receive a lot of support from the government, then I might actually survive, even when facing competition from much bigger businesses. And I have a last one. Yeah. But I think I'm going to remove this one. Yes. Okay, let's just remove this one. It's true that in some countries, if you are a small company, there are special programs for you to borrow money at a low interest rate, but it really depends on the government regulation. But there are some systems where if you are small enough, the government is going to basically be your collateral, or you just not really your collateral, but just say something like, okay, if the company does not pay back, I will pay back. So therefore that allows you to borrow money at a low interest rate, but this is not always the case. So I think we should remove this one because it might be a bit confusing. All right, so these are just a few reasons for which small businesses may survive, even in an industry where there are much bigger businesses competing with them. And that's it. Okay. Any questions? Well, that was it's been 3 hours exactly. I think that we've just established a new record together. All right, and I hope this was not too intense, too boring. I did my best to keep it as clear as possible. I feel a little bit sick today, maybe because of allergies, so I did my best to to explain things as clearly as possible. I hope this was clear. All right. Well, thank you very much, guys, for joining me tonight. The video recording, of course, will be available very shortly. And you will be able to download everything. So again, I still need to add the summary of this last PPT and the concept cards and the definitions. This is probably going to be the case tomorrow. And yeah, so next week we'll talk about market structures, and we'll start discussing perfect competition, which is the first market structure we need to analyze. And for those attending the AS workshop tomorrow, we will talk about market equilibrium, interrelationships between markets and consumer and producer surplus. So that's going to be pretty easy tomorrow for AS. Okay. Have a nice evening, everyone. Happy Mid-Autumn Festival, and see you either tomorrow or next week. Have a nice evening. Bye-bye.